Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss avoid equity bear markets with a market timing strategy, part 2.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. Today we will continue in our series that's related to market timing strategies. In the first video we discussed the price-based market timing strategies. The strategies that are trying to pick the right time to enter US equity market. And in this second installment, we'll discuss not just the price-based models, but we will also discuss the economic and macroeconomic models of how we can use the macroeconomic information to time US equity market. Very quickly, so what is the market timing about? So there are a lot of market timing strategies in our database. In market timing strategies, we are trying to pick the right time to enter the market and the right time to exit the market at the time when we are trying to avoid the big drawdowns that are connected to US recessions or that are connected to recessions and bear markets in equities. So the first article that we discussed in previous video was how to avoid equity bear markets with market timing strategy using price signals. And then now we will discuss macroeconomic signals. But firstly, I will show you how does usual market timing strategy using macroeconomic signals look like. So we can take a look on the Fed model. The Fed model is a strategy that's freely available on our webpage, so you can read about it. You can check all of the research papers that are related to that. Now, the Fed model is a favorite name for a model because it's a model that is loosely based on papers published by Federal Exchange a lot of years ago. How does it work? It shows that there is a predictability in a spread between the earnings yield on US equities and the 10-year Treasury yield. So it has some predictive power on the short-term horizon during the last, 40 to 50 years. So if you use this information, so if we each month conduct a regression and we try to predict excess stock market returns using the yield gap, which is calculated as a difference between earnings yield and the actual yield on a 10-year Treasury bond yield. And then the strategy allocates 100% in the risky asset. So in US equities, if the forecasted excess returns are positive, and otherwise it has 100% in the risk-free rate. So in this case, we are not using price-based indicators like a moving average or momentum or whatever. We are using some fundamental macroeconomic information. In this case, it's a yield on US treasuries and yield on the equities. So this is how the usual macroeconomic models look like. Once we know it, so we can continue our installment and we can check how we can improve the price-based indicators with macroeconomic information. For this, we get inspiration from article from Philosophical Economics that was published in 2016. I really recommend you to read the article. It's a little longer. The link is in the description of the video, but I really recommend it. They are using the retail sales growth and industrial production growth as information that they use to improve the classical trend following strategy. The problem with the classical trend following strategy is that it very fastly gets you out of the equities, but the problem is that when there is a choppy market, it's not very good for trend following, and you are going out and in and out and in, so you are each month you are switching between having a position and not having a position. That's very deterrent for your performance. So when you use the macroeconomic signal, you can use it as an enhancement because it will better show you whether the recession is coming or not. So it means it will help you to time the market better. So the original philosophical economic strategy was that in case that retail sales or industrial production are not growth in industrial production year over year is not negative but still positive, you are not going out of the equities even that the price signal is showing you to get out. The reason for that is because the economic situation is still good. It's a waste of the time to get out of the equities when the economic indicators are not deteriorating. So that's how the philosophical economics improved the original price-based settings. I really, once again, I recommend to check the article. We try to replicate the strategy. So we did a combination of sales industrial production. We can compare here is the naive macro one, so that's the strategy that combines these two macroeconomic indicators, and we can compare it to traditional price-based naive market timing strategy. So we can see is that we have a higher annual return, and the reason for that is because we are more often in the market. So it means instead of just being in the market for 67% of the time, as in the case of price-based strategies, we are in market 82% of the time. So it means we are significantly more in the market. The risk is not higher, so it means we have maximal drawdown higher only by 3%. A little higher volatility, but it translates into better Kalmar ratio and the Sharpe ratio that's nearly the same. So that's how philosophical economics strategy works. Now the question is, can we improve the strategy? What we tried. So firstly, we tried some commodity indicators. There are a lot of papers related to how you can use the commodities to time equity markets. I mean, the logic is that the demand for industrial commodities like, I don't know, copper, oil, or lumber relative to the demand for, say, haven assets such as gold. I mean, it has been traditionally seen as a leading indicator of global economic health. So if the demand for copper or, I don't know, oil or lumber is growing, while the demand for gold is the same, it means that the economy is probably improving. We tried to build three trading signals when we compare performance of the copper or 3-month performance of the copper to gold, 3-month performance of the oil to gold, and 3-month performance of the lumber to gold. And then we use these indicators to time the equity market. Also, we are trying to use another economic indicators, unemployment and dividends. Growth in dividends or fall in unemployment rate can also show there are positive times ahead of us. So we can try to improve the original strategy proposed by philosophical economics. Now, how does it look like? All three commodity indicators are not significantly improving the original naive market timing strategy, I mean the price-based strategy. So if we compare, we have a higher drawdown. Here is the benchmark, the naive price-based strategy. And if we compare the commodity-based market timing indicators, you can see that in 2 cases we have a higher drawdown. Yeah, in few cases we improve the Sharpe ratio. We can check the unemployment rate and dividend. We can have a higher performance, but also higher maximum drawdown. The Sharpe ratio is significantly improved. The unemployment rate and dividend signal probably would improve the original philosophical economic strategy more than using the commodity-based indicator, the macroeconomic indicators. That was the result from our analysis. So with that understanding, we combined not just 2 signals together, as in case philosophical economics, but we combined 4, unemployment rate and dividend. So we are not just looking at what is the change in industrial growth and what is the change in retail sales, but also what is the change in unemployment and in dividends. And then we combine all of those 4 signals together, and when we combine them together, the market timing strategy is improved. And if we combine the macroeconomic signals together with the price signal, complete strategy is written in text, then the resultant trend and macro strategy improves even better. So we have the lowest drawdown, minus 42%, interesting Sharpe ratio, and the highest Kalmar ratio. That's how we can improve the price-based strategy with macroeconomics indicators. But that one more thing, I will discuss it in the last video, in the last article in our series. We will take a look on yield-based recession predictors. So what is the slope of the yield curve? We will see that one of the best predictors how we can predict the upcoming recession. And we will wrap all of the ideas together and we will build the final strategy. So thank you very much for your attention for this moment. I really advise to check the article written by Philosophical Economics, and we will meet each other again in video number 3, in which we will wrap up all of the ideas together. Thank you.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.